Hello friends, this is Ritesh from retailritesh.com and welcome back to weekend video series. Today we are going to talk about a principle of management which is called accounting and financial management. If you all know that we as retail professional keep on doing a lot of analysis based on our past sales, past performance in order to plan for the future. So what does actually we do? So basically we take accounting or auditing figures of our past performance, whether it is a store like for like organic sales, or you can even consider something like sales per square feet last year versus this year in like to like stores. So we do various kind of analysis from time to time in order to plan for our future. So accounting is basically tells us about our past performance, and planning helps us to plan for the future. So planning without accounting, according to me, is nothing but a wishful thinking. It is just a goal without any action. So the current management principles or accounting principles are being disrupted by various retailers, by a new concept which we normally follow. The accounting, they follow something called GAAP, which is generally accepted accounting practices, are being challenged and disrupted by the new kind of retailers. The concept of customer acquisition cost and lifetime value of a customer, these two parameters are now being visible in your P&L or in a balance sheet of some modern retailers, which are basically e-commerce companies which are trying to go into physical retail. So all the accounting principles are getting outdated at the moment. The new norms, the new accounting principles are being developed by various professionals, and I have written my thought process on this article on my blog retailritesh.com. That tells us how luxury brands are disrupting the retail financial accounting or financial models. So please read the article. And one of the quick tip which I would like to tell in this video is, you might have observed in the malls the big size pop-up shops of various luxury brands like Gucci, Hermes, you name it. Those big pop-ups are there in central atrium or the mall. So how does retail or those brands able to sustain the high cost of rentals? The answer is, in their P&L, they don't consider it store rents or promotional cost as an expense. They consider it as a customer acquisition cost. My friends in accounting and finance management will argue with me, saying that both are the same thing, but it's a different terminologies. I agree with them on partially. It's a different terminology, but it also tells the different mindset. It sets the different tone of a mindset. When you talk about store rentals, it is an expense header. When I talk about a customer acquisition cost, it goes as a long-term investment. So there is a big difference between a current expense and a long-term investment or a long-term expense that you do in your balance sheet. So that's a new norm, a new kind of accounting practices that is emerging, and I would request all my followers, my readers, to please go on to retailritesh.com and check out this article. I'm providing the link in the description of the video as well, and I would request you to take a look and express your views and comments by commenting onto the comment section, and request you to keep following retailritesh.com for interesting strategic business insights, and wish you all the best. Stay connected. Thank you.